Now I'm just gonna start this all over again. There we go. I did that. That was on purpose. I just wanted to make sure I was recording still. All right, welcome everybody to it. Oh, look, I didn't change the title. See, I knew there was something I didn't do. There you go. It always happens. There's something. See, anyway, this is Think with a Drink. It's a weekly webinar series brought to you by the Aries Foundation. And because today has been a crazy day, I forgot to switch out the title screen. This is actually, should I be worried about my 401k? Or actually, we would parentheses that at the bottom, any retirement plan. We're not just singling out 401k. It could be a 403b. It could be a simple. It could be a SEP. I was funny. I was thinking about this because I was just doing something with tinfoil, right? If you think about the thing that you blow your nose with, what do you call it? Kleenex, right?
Well, I guess, yeah.
Right, like Kleenex, right? You don't call it tissue paper.
Or
But tinfoil is tinfoil. It's not like there's no brand name really that you associate with tinfoil.
saran wrap. No.
No, that's saran wrap, dude.
Oh.
That's the clear plastic stuff. That's not saran wrap. That's, anyway, so it's just funny. It's 401k as the retirement plan is where that little diatribe went there. All right. So the pre-flight checklist as we're starting up here. Just know the event is being recorded. Just keep the microphones muted. Cameras are off, so don't worry about it because we're the only ones who are shown on the screen. There is a chat box, however, so please, if you have any questions, drop them into the chat box, and the co-pilot will keep us in line and keep us on pace with that. Speaking of your pilots for tonight's journey, my name is Tom Alessi. I'm the president of the Aries Foundation. I have been in financial services for 24 years. I am an investment advisor. That means I act as a fiduciary whenever giving guidance or advice to any of my clients. I'd like to bring my vice president, Craig. Why don't you introduce yourself?
Sure. So I'm Craig Richardson. I am the vice president of the Aries Foundation. I've been doing this a little over 19 years now, and I specialize in working with families to help them define their financial goals and have a better relationship with their money.
And Craig will be chiming in as we go along on tonight's journey. And like I said, if there are questions or need anything, just drop them into the chat box and we'll try to get those answered. Just as we mentioned, Think with a Drink is brought to you by the Aries Foundation for Financial Education. You can visit our website. It's ariesfoundation.org. And the mission behind Aries is trying to help everyone have a better relationship with their money. I mean, what we try to do is help everybody sort of take the step back and really find the why to how you're dealing with your money, whether that's spending, whether that's saving, whether that's how you actually interact or feel about money, because everybody's got a different view, everybody's got a different take. And so we try to help everybody sort of get a sense of that, because I think that's one of the things that drives people really to have that sort of like, money's not my thing, or finances is not my thing, or it's too challenging, because there's this sort of taboo that exists.
Well, everybody has their relationship with money, as we talk about, right? And how you define that relationship actually defines a lot of what's going on in your life, whether you have enough or too much.
Right, and how you view that, right? And that's basically what, where it comes down to is how you're viewing, like that. Do I need more? Do I have to have more? Or I feel like I don't have enough, or gee, where am I at with that? And a lot of that does get into that sort of that belief system that you have about money. That's what we try to do. All right, so there's a lot of words on the screen, and as I tell you every week, I'm never going to read them, because you can sort of go through that. But just know we're a nonprofit. We do this for education and informational purposes. We share this on our YouTube channel. We share it on the website. All we ask is that if you're going to share it, you do it in an educational manner. However, myself, Craig, the rest of the Aries team, we will always tell you that if you have questions of a tax, legal, or financial matter, that you seek out the help of a professional to get those questions answered. Don't ask your neighbor, don't ask your coworker. Find a professional who can help you answer those questions. That brings us to the fun part of this evening. We call this Think with a Drink because one of those ways of trying to, what do they call it? Break it down or lower the wall on the conversation. What are you trying to do when you do that, right? You're trying
Lower
to
the temperature. Yeah.
No. When you're trying to bring down the defenses, right? You're trying to lower the defenses that everybody has, right? So that one of the ways we do that is by making this more casual, more relaxed. We try to speak in a regular manner, not finalese or legalese or any aspect of that. But we also can't think of a better way to do it than if we had something cold to sip on while we're going through, and we encourage our audience to do the same, so long as you're not driving or need to be driving later on, or have a tea like Craig does every now and then instead. For tonight, I've got one. This is really cool because I found this one and I said, you know what, with the worry about the 401k and what's going in the markets, so I have for us short sell. This is from Exhibit A in Framingham. It's an American India Pale Ale. Basically this is it's like a farm to market, back to farm thing. Like they donate back, and it's like every case or something buys X amount of reusable farmland that can be propagated basically by it. So there's a mission behind this. But for us, a short sell, hey, it's what's going on in the markets, and it's really a scary thing out there. So I thought this was an appropriate title. What do you got for this evening?
I have one by our friends at Treehouse called Big One. It's
Big One. Well,
yeah.
See, there you go. That's the other side. See, I've got the short side, you've got the upside. So there you go.
Yeah, it's a triple hop. It's supposed to be
Ooh.
Yes.
Skull.
So, oh, that's good.
Yes, no. This is definitely very refreshing, very good. And I like the can. It's purple and the whole thing, like it's very, very cool. Short sell, Exhibit A. You got to check that out. All right. So the agenda. Have you looked at your 401k? Has your time horizon changed or been altered? Are you just chasing, or the other way around, that's chasing return, not thinking about risk? What are the steps? What can you do, right? And what's in your buckets, how you're viewing what's going on with what you've got inside your plan. Should I be worried about my 401k? This was a posting for us earlier this week, right? They can't roll over your 401k. All it knows how to do is beg and play dead, right? So, that's sort of what's going on with the 401k space. We hear this on a regular basis with people like they're upset. And, unfortunately, in the markets this year, especially, there's been no place to hide, right, Craig? It's just been, it didn't matter what you were in, didn't matter what you were holding, everything is down.
Yeah, I mean, the issue is the bond market's been, in the toilet for a while. And then everybody was racing to the stock market, but that's dropped. So then what do people do? They go, oh, I'm going to run to crypto. Well, crypto's in the tank with FTX and all that big news this week. So you're right. I mean, you can't even move to savings because banks, even though the interest rates are going up, haven't reflected that in the savings rates. So
correct, and they won't for a while. Probably sometime next year, you'll start to see a little bit of a tick up.
Right.
But,
so where do you go? I mean,
well, right. But now we're talking about 401k, and in a 401k, a cash account, right, is either a money market, which is the same thing like the banks. They're not getting anything. Talk about playing dead. That's what your 401k is doing there. Or it's a stable value, which does have a little bit more of an increase. And you'll probably see if you have a stable value option somewhere in the twos in your 401k, but still it's 2%. There's no reason for somebody who certainly has more than 10 plus years to retirement to have money sitting more than a 5 or 10% swatch in cash, right? There's no reason in your retirement account.
Well, the other issue is you're getting 2% and 8% inflation environment.
Yes. So then you're really playing dead, right? You're definitely begging at that point. All right, so the question was, have you looked at your 401k lately? And I don't know, I did this, I put the little, the sick face up, and I wasn't sure if that's what your 401k looks like, or this is what you feel like as you're going to open your statement, or just the thought of opening your statement and looking at it at this point. For us, a lot of times we tell people it's better to just not even open the statement. Like, don't even look, because you're just going to feel sick once you do, because you're just going to see everything, like we said, everything's down 20%, and in some cases more. Or as Greg said, God bless if you were one of those people who put crypto into your account. Bitcoin is down 65% from the high of a year ago. So what actually now it's probably closer to 70.
Mhm.
So the adage here is there are reasons to look at your account if you're going to be proactive, and we'll talk about those proactive steps in a little bit, right? But it isn't to panic. I think with maybe with your other accounts, it's okay to panic. Maybe you should have already done that already. It's a little late. This might be now the feeling that you have. That's what you look like, having not done anything and looked at it. But as far as your retirement account, it's more of being proactive with things than it is being, like panicking about it at this point.
Well, I think it's the other view too, is this a long-term investment or a short-term investment? Right. And I guess some of that depends on your position.
Correct.
A couple of years from retirement, it's a shorter term window and you're a little more concerned. If you're 10, 15, 20 years from retirement, then you have a longer window and you shouldn't be concerned. So,
Right. And you shouldn't really be worrying about it and going through that. And we'll talk a little bit about that. We'll go through it in terms of looking at that and thinking about it, right? Because the adage here, and it's a joke, and we're trying to be lighthearted, and like we said, we have a little fun with this. But if you think of the markets as a roller coaster, right, an up and down swing, and stuff goes all over the place, the adage is the only person who gets hurt riding a roller coaster is the person who tries to jump off mid-ride. And that's the idea of selling out as the markets are doing its dips and its bumps and its thing. And one of the biggest components of being a retirement plan investor is that you are putting money in as the bumps and swings and hits and misses are happening. And we'll talk about that in a second in terms of how that works and what it is. But the idea is it's more of, should I be staying the course versus trying to sell out and move to something else? Because I think that's where people get hurt, right? Is that selling out, like this dramatic shift in my investment strategy or my tolerance because of what's going on right now in the markets.
well, once again, it's because when individuals invest, they invest emotionally, right? They don't invest in an institutional way. So what they do is they see a loss and they go, well, I got to protect myself from a loss, and they shift themselves out of the market. Well, what happens is you create a fixed loss. You can't come back if you're not in.
Right.
Go up if so that's where you got to, when things are on sale, you got to look at, what do you do when things are on sale? Do you sell?
No, I buy.
You buy.
I buy.
So the opportunity here is you're in a great buyer's market.
Yeah.
So
Yeah, and we'll talk about that in a little bit with the adage on that. But the first thing is, has your timeline changed? Like Craig said, for those who are closer to retirement, i.e., within a 5-year time window of planning for retirement, has this dented or changed your timeline? Are you now, if you were trying to retire at 65, is it now 70? Is 70 now 75? I mean, is it you now? I couldn't find a really, really old person working. That's what I was trying to do. So in terms of that, but so it's sort of like Craig had mentioned earlier. If this is longer term, if you are thinking about this as, I am investing and I have 15, 20, more plus years to go until I get to retirement, then why are we talking about altering whatever investment strategy you were doing? Your timeline is there. That's the point. If your timeline has altered, or it might be the reverse, quick, like we've talked about, and we just, we were doing a presentation earlier today where we talked about people who want to retire earlier, want to get out at 60 or 62. So if you're in your mid 50s and that's the timeline for you. Or worse, you're 60 and, the job just evaporated. Now it's like, well, okay, I've got nothing else to do. Where am I going to go? That's a change in the timeline. Then that's a change in the strategy.
Yeah, and that's what I try to caution people about. Like, I think everybody wants to retire early, but when you look at the environment we're in, where a lot of accounts are down, I mean, everybody's position may be different. But when you retire early, you're not retiring 1 or 2 years early. For every year early you retire, you're actually retiring 2. So if you decided I'm going to retire at 60, you're not retiring 5 years early, you're retiring 10 years early.
Right.
And that's because you're not getting a paycheck and you're drawing out of your savings. So it's a double hit. It's not a single hit.
Right.
Something to just keep in mind.
Yeah, something to be adding up as you're looking at that and thinking about it. But for some folks, this has altered the timeline. If you were 3 years to retirement, this 20% dip in your accounts now may have put you in a situation where you're like, well, I have to wait until it comes back. I don't know when it's going to come back. And it may not be for 3 years until it comes back. And you may have been planning on 3 years of gains to get you to a point. So if it's 3 years to come back, then like Greg said, then you've got a couple more years to get those gains that you were thinking of having. And now we're talking a timeline of like 6 years instead of 3.
Right. You definitely got to give a little bit more thought to your distribution strategy. That's for sure.
Yeah, and we'll talk about that at the end. We'll bring that up in terms of going through that, because I absolutely agree on that. And so we talked about staying the course, right? So staying the course inevitably for retirement plan participants specifically. And we said retirement plan, so that's 401k, 403b, simple SEP, etc. Anybody who's got money going in on a per paycheck basis, you are doing what is known as dollar cost averaging. You are buying as the market goes up. You are buying as the market goes down. You are inevitably doing better than somebody who's trying to time the market. Timing the market does not work. Inevitably, you're either in front of the curve as it drops, or you're behind it and you miss the bounce. So, we talked about this in a post last week that last Thursday, the day before Veterans Day, November 10th, may have been the best day of the year. The S&P 500 went up 5%. That may have been the biggest single bounce of the year. And if you were sitting on the sidelines or had money in cash or sitting in a money market or just as Craig said, out of the market, you missed it. You missed the bounce.
I didn't look at my 401k, so I was still in. I did not miss the bounce.
See, there you go. You just had a sick feeling, but you were okay with that sick feeling in terms of doing it. But that's the thing. That's part of it. Like missing one day out over 10 years will cost you a 0.5 point per year. 0.5 percentage point just by missing the single best day of a year. And then if you compound that and spend more time out and missed, the 5 best days, you're missing almost 4% on the return. It's crazy numbers, like just by missing the best days. So for retirement plan, 401k participants, employees, continue to stay in. Don't move. Like Craig said, don't take the loss. You're not selling out. I mean, taking a distribution, but by selling out, you're parking your money on the sidelines. You're not getting this dollar cost averaging to work for you in that situation. So it's okay, have the sick feeling, but leave the patient alone. Don't try to like doctor or play with the patient. Be like, what is that game with the operation, right? Is that what it is with the red nose and the thing lights up?
I still love that game.
Right. Okay. So don't play operation with your 401k. Maybe that should be the next post. Like, don't play operation with your 401k. Leave the patient alone. I like that one. I'm going to use that one. All right. So we're talking about risk now, because what happens for most, whatever, and every investor inevitably is chasing returns, right? But we did a whole presentation last week, and we've done before on, this whole, for retirement, it's sequence of risk return. That's where Craig was talking about. We'll talk about it at the end with the distribution strategy and taking money out of your account. For most investors, it's this chasing of returns, right? I'm trying to only think of what am I getting? Like Craig, we hear that all the time. Like, oh, what's it going to get me? Or what am I going to get for a return? Or how much is that you're going to return me? And it's like not the way to be thinking about it, at least from our expectation. For Craig and I, we always want to talk about the risk side. How much are you willing to lose to get to that return? Because that's the number that everyone sort of has to come to grips with. And I think this year, 2022, has specifically taught everybody that chasing returns does not work. That's the Bitcoin story.
Well, it's not sexy, but I like this turtle in the hare scenario when you're looking at investments, right? The hare might get there quicker. Oh, look, I got a great big 25% return, but the next year you lost 30%. So now what's it take to get back? Where the turtle, maybe he's getting 5 or 6 on an annual basis, but he's not taking big losses. So who gets there faster at the end?
Well, and the problem with it from the retirement plan side, like when we're dealing with this in the 401k space, right, specifically, which is what we're talking about, is that having this set up and then, the situation occurs this year and you're 3 years away or even 5 years away, this is devastating to that timeline, right? That's why that chasing return thing really doesn't work. I mean, it works when you're 20 or you're 30 and you got very little money in the account. And so what are you really risking at that point? And you have 2 more lifetimes before you're going to get to retirement. But when you're in your late 50s and 60s, now suddenly taking that risk is a huge number that's going to come off that you really are going to be struggling to get back, especially if you were trying to get out in 2 or 3 years.
Well, the other problem too, Tom, let's face it, especially with all the stressors on people's money these days, a lot of people don't really take their retirement seriously until they get into their 50s. And so now they're playing catch up. I mean, you only catch up in 2 ways. Either you're putting a lot of money in or you're chasing returns, right? So
I was just checking the alcohol content on the beer. It's not high. It's great. It's very tasty, and I just wanted to make sure. But
so you feel it already? My gosh.
No. I was surprised because I'm like, gee, this is really tasty. I'm enjoying this, and I wanted to check so in case I wanted to have another one.
So that's the other part. Like I said, if you are that person who's trying to play catch up, then you really got to look at, accumulation is great, but you really want to be looking at distribution strategies that are going to make you more efficient with what you have.
Right. Absolutely. In terms of that, and so we talk about this, and Craig mentioned it a little bit, this whole idea of withdrawal strategies for retirement, because we're talking about your retirement account. And your retirement account, when we talk about probability of running out of money, right? So that's what this is sort of showing you is, hey, look, I'm just going to pull money out. It's not telling you how much of a return you're trying to get. You're just pulling money out. And whether or not you can actually successfully do that out over a period of time. And, I know for a lot of people that, well, I'm not going to live that long, but, the average life expectancy, we did that today too, which was a male is 85 and a female is 87 right now. So if you're retiring at, what is now Social Security full retirement age for a younger group, 67, 87, that's 20 years. Yep. 20 years at this is the red line here is a 4% withdrawal rate is not 100%. It's not guaranteed. And that's if you had $1 million, that's saying you're living on $40,000 a year just to get you to 20. And that's average life expectancy. If I bring that number to 5, which isn't, getting me all that much more money, right? Suddenly I'm down to like a 92%, 93% success rate.
Well, nothing. You said if you retire at 67, how many people are we talking about right now want to retire at 60, 62?
Right. And then that brings me out here to the 25-year number, which really starts, the 5% thing starts dropping into the 70% range with that.
Right.
And that just that's a very scary outcome when we're talking about $1 million and having 50,000 a year to live on, and I ain't guaranteed that it's going to survive. That's a scary thought for it. So it's part of the process and thinking about what's going on with your money, right? So what can you do to sort of be prepared? What are the steps that you can do, right? So we already talked about one, which is stay the course, right? You can certainly do that. But the other is you can rebalance or reallocate. So rebalance is a strategy. Now, for a lot of people out there, you're probably in a target date or some sort of freedom fund, journey fund, whatever, God bless, with all the cute little names they call them in terms of dealing with it. But those are automatically rebalancing for you, except for they're very, very aggressive right now. So you probably got pummeled if you're in anything from a 20, 30 beyond target date fund, because they're extremely aggressive setup, but they'll rebalance for you. In the case of somebody who's picked a couple of funds, like what this shows you is, hey, I got 70-30 mix, that's equities to bonds and cash, but we know stuff happens over time. And certainly the last couple of years, equities did great, and bonds, as Craig said, what did you say? Your quote was in the toilet, as I believe your quote was.
In the toilet for a while.
So essentially what happened is equities were running up and bonds were shrinking. So your portfolio got out of balance, right? It wasn't 70-30 anymore. It was probably closer to 80-20. And if you didn't rebalance it, if you didn't set it back to being 70-30, when the market tanked, you were overexposed and you got hurt even more than what you had originally intended.
Rebalance itself.
Yeah, right. It rebalances out. It back. So just now a smaller round versus the bigger round. But the idea there is to go back and either, a lot of plans, and you got to check with your retirement provider, a lot of them will do an automatic rebalancing for you. They'll have that feature in the software that you can check on it. If you have questions on that, that's why we're here. We're happy to go through that with you. But it's usually, I can do it monthly, I can do it quarterly, I can do it annually, whatever, in terms of going through that, which is a great feature and certainly makes sense to do it. If you've picked your own funds and set it up, if you have a portfolio that was built for you, like the Freedom Funds or something else, they're doing it for you. So that's okay. The other is to reallocate. And reallocate says I'm making changes. But again, if you're going to reallocate, there should be a reason for that reallocation. It should be based on your own risk tolerance, not, hey, the market tanked, I want to move everything to cash type of thing. It should be like my timeline altered or something changed in my makeup that I now want to make a switch.
Yeah, that's why some of those, automated ones, the target dated funds are nice because they have a glide path. Well, they automatically change as you get closer to retirement.
Yes. Yeah, and that's the reasoning for it. And so a lot of times that will be, but it might be, okay, I'm in a glide path, I'm in a freedom fund or a journey fund or whatever you want to call them, lifetime fund. But maybe now I want to add something else to it. Mm-hmm. So I can keep the allocation. And one nice thing for all retirement plan participants is you have the ability to change the allocation of the portfolio, what the money that you have in the plan, or you can change the future money. That means the contributions you're going to be making as you go forward in time. So a lot of times, Craig and I will talk to people about, okay, let's keep the portfolio where it's at, because you built that off of risk or tolerance or whatever you had, but you want to make some changes. Let's look at changing future money, which will be adding in and slowly changing your overall mix, because you're going to be doing it a little bit at a time through dollar cost averaging, like we talked about, which is better than trying to just move the whole portfolio at once, because like we said, timing the market never works.
Well, and this is once again one of those situations in your 401k where you want to try to leave your emotions as far out of it as possible.
Yes,
right.
Absolutely.
You really want to take the math, perspective on this one.
Right. Yeah. And so the bucket strategy in retirement, we talked about this before, and we will bring it up again. But you want to be thinking of different buckets for your retirement, right? So your tax deferred, that's your 401k. Your after tax, that may be a Roth, that may be a mutual fund or ETF or some other strategy like that. And then you have guaranteed. And right now, for most people, the only guarantee bucket they've got is Social Security. They don't have any other guarantee. And so the idea is to be thinking of it from a strategy of, can I create my own personal pension plan? And this is more for people as you're getting closer to retirement and thinking about how am I going to be generating that income that I need, where I don't have to worry about this anymore. I don't have to worry about walking into a 20% decline in my retirement.
Well, a couple of things too, Tom. When you're in the retirement, now you're at a fixed income. You're not working anymore.
Right.
And what do people want in retirement? They just want certainty. They want to know every month I make enough money to pay my bills and do the things I want to do. The other problem that happens when you don't have guaranteed income is it can't take the pressure off of your other money. Can't take the pressure off of your savings. Because when you have a dip, where do you got to go? You got to go grab your savings, right? So you don't want the market to be affecting what happens in your retirement. The other problem is that somebody at some point, you either lose the desire or the capacity to manage your money.
Mm-hmm. Right.
So in that case, you still want to make sure your income is guaranteed for as long as you're alive. So there's lots of reasons to make sure that part of your income is a guaranteed income stream that is uncorrelated to the market.
Right, because then you don't have that headache, you don't have that worry, and you don't have to fear of that the markets are going to go down, because that's right now what's going on. There's fear out there in terms of everything that's happening. And one of the other parts to this strategy that we talk to people about is creating a buffer. And so the idea there is I've got my retirement account that's all set up, but if I was retired right now and I was trying to draw income out this year, I'd be taking out in a severe down market and just compounding the downside of my portfolio, which it would take me even longer to try to get back, which I may never get back because I'm going to do the same thing next year and the year after that. And if the market is struggling to come back, I've now dug that hole, it's like double dipping into the bucket. I'm taking more out than necessarily there. The buffer strategy allows you to have a separate piece, a place where your money is sitting that I can then, if in a down market, so instead of taking out of the account that suffered this year, I dip into this other bucket and I use that for my income. And I allow my investments to mend, to heal, to do, at this point, it's like, God bless, it's on the table, getting like what are those things with the electroshock things? What is that? Trying to
Defibrillators.
Yeah, the defibrillator, right? It's what is the joke, right? It's
jumper cables, one or the other.
Right. My 401k is now a 201k, right? And trying to zap the thing back. But that's the idea, that you would not take it from that account. You take it from this other account, which creates the buffer, so that your investments have a time to recover. They have time to come back before you actually have to then draw income off them again. And for most people, Craig, they don't have this set up. They don't. It's like a concept that's just not even set in anybody's mind.
Well, it's foreign to even a lot of investors. Financial advisors out there, because they're all about the accumulation strategy. How much can I build a pile? Right. In this particular instance, in this particular is showing it using life insurance as that buffer. But the issue is to have a cash balance that's uncorrelated to the market. Right. So it's not going up and down when the market goes up and down, whether it's
or going to be affected in any way, just not even markets, but interest rates or anything, like all the stuff that's going on. You got to have something that's not going to be pummeled while it's sitting there.
Absolutely, because that's the only way you have a buffer. If it's affected by the market, then your buffer gets affected too. If it's right.
Yeah, then you can't touch it because you got to wait for it to come back.
Right. Absolutely.
And so that's what Craig and I try to do. That's what Aries tries to do. The foundation is set up, trying to help everybody have a clear vision of the road ahead, of what you're trying to accomplish, where you're trying to get to, whatever that goal might be. And what we offer to everybody is to have a conversation. Let's just have a conversation to see where you're at. What goals have you set? Or maybe you thought about and haven't set yet. And what Craig and I try to do is help everybody do that. You can see on the screen there's a QR code. There's also a link. You can scan or copy and paste, either one. But if you shoot the QR code, it opens up the calendar just like the link does. And what you're going to get is our scheduler, and we're happy to have a conversation. All we're trying to do is have that dialogue that just says, here's where I'm at. I'm not really sure where I'm going. And I just want to make sure if this is where I want to get to, right?
Absolutely. I mean, this stuff is so complicated that it's hard for your average person, regardless of your level of intelligence, to keep up with everything that's going on in the marketplace. Between laws changing, rules changing, market changing, there's just so much going on. So even your best quarterbacks have a coach.
Everybody has a coach.
Right? So let us be your coach.
Yeah,
No cost and no obligation to you. Have a coach.
absolutely. So we keep the Think with a Drink theme going with what's on tap. What's on tap next week is Thanksgiving. So God bless. Craig and I will be passed out in front of the television. So, watching football, and he's talking about getting like 2 or 3 turkeys at this point. So I'm not sure how much tryptophan he's going to be dealing with. So just know it's Thanksgiving. There is no Think with a Drink next week.
Who's Dallas playing next week?
Dallas, God bless. I don't know. Dallas plays Detroit. Did you know they moved the Buffalo game to Detroit?
I did not know that.
I just hear that because they're getting like 6 feet of snow in Buffalo this weekend. So they moved the game. Buffalo is going to play in Detroit, of all the things in the world. How about that?
We're going to get snow too?
I don't know about us. So on the first, we're going to do surviving the holidays financially. We can't help you survive the family. That's a different conversation, a completely different, part of this. But we're surviving the holidays financially. And then on 12/8, we're going to do Are Annuities Bad? So that's how we keep Think with a Drink going. Questions, Craig, anything in the chat box?
I have nothing in the chat box at this time.
Okay, so you can go to the www.ariesfoundation.org. You can check out the website, email us info@ariesfoundation.org, or like I said, if you want to shoot the QR code, or if you were able to copy and paste the link previously, we're set up. We're happy to have a conversation with you. And on that note, I am going to stop the recording.